Hello everyone, welcome to Smart Investing. This video is going to be based on the banking services sector. So this is actually video number 70. So in order to start off 2023 correctly, again, I know my old videos were boring because I covered so many companies, but so much time. So now I'm trying to do my videos better. So hopefully you guys can see how I evaluate it, and it won't be so many stocks and so much time wasted. So, uh, the first stock out of the five, and I'm only going to review only one stock for this video, but the next four will be featured. So, the first one that I have up is this one, CAC. Then the next four, will be reviewed at a later time. So I'm going to try to make this video 15 minutes or less. So for this stock, CAC, Camden National Corporation. So obviously is a banking services sector stock, also known as the bank stocks. So we have here a price of 41.36. Let me just say some info before I even start. Today is Tuesday, December 27th. It is 11:23 p.m. I'm a little tired. I hope I don't slur my words or anything, but yeah, I have here just one stock here. So again, markets are closed, and tomorrow markets are open. So we're gonna look at some fundamentals, technicals, and some quants, and then uh, whatever else we have for information. Hopefully, all the information shows up. Then we'll analyze this company and see basically if it's a good company or not. So here we go. So $602 million market cap. I think that's really small. We have here on the first page, looking at some numbers. It's looking undervalued. Then we have the 52-week high and low. Difference of 12. Not bad. Earnings per share 4.2. That's not bad. So dividend yield is at 4%. Again, uh, I'm only showing the percentage because people prefer percentage rather than total return. And again, I've said this plenty of times in my videos. Uh, the total return for the dividend when it comes to income, the total return is more important than the actual percentage yield. Uh, because again, during rough times, and obviously in a log, and when you have data, when you have long periods of time, whether it's consistency for months, weeks, and even going into years, you want to have that consistency based on years. So with a high dividend yield, you're going to be sacrificing, usually like 95% of the time, you're going to be sacrificing the total payment for the dividend, basically what they pay in dividends. So yes, you might get a higher yield, but I've said this before in other videos. If you're looking for that income, you're you're struggling to keep up with the income because you're working harder to get gains, and basically your money is not working for you, you're working for your money. So basically, again, you have your high dividend yields, but you're not getting any raises. You might get random payments, which is, it could be on different days, or just the actual amount might be different. You got to make sure everything is consistent. You got to make sure when you do get increases, the increases are about the same, if not more. So, like, let's say you got a 3 cent raise, then next year, all of a sudden, you only get like a 2 cent raise or a 1 cent raise. That's just not good. You always want to have uh, better returns. You just don't want to stay the same. It, I mean, it's just common sense. When you look at the numbers, you go over it. So anyhow, moving on to the charting for this. So again, for the fundamentals, I mean, they look okay, but I think there's better options out there. So for CAC, look at the technicals here. To me, it looks pretty flat. I'm not fond of it. Obviously, we had a nice gain for 2021. And then for 2022, that's when things went sour this year. We're about to close the year in a few more days. So, I mean, it's held up okay for 2022. But again, you're at a slight loss, looking at about $4 for a loss if you bought at the high, which is not bad, really. It's not bad of a loss. It's crazy for me to say that, but I've seen worse. I've seen bigger losses than that. So for it to be holding up for that long and for that amount in that range, within not even a $5 range, really, it's like a $4 range. That's actually not bad of a loss. So now we want to analyze and see what this stock is actually good for, what strategy. So quant ratings we have here for overall rating, they have a 3 out of 5. So it says here, higher the rating, better fundamentals. And obviously it says only for fundamentals, but I think it could also be used for some technicals. We want to see how much volume was. So volume was around 50K. That's actually not bad in general. So highest rating that it has received is quality at a 7.4. So 7.4. So this company must be doing something right. Now, gonna look at some financials here, fundamentals. We see here in Q4 2021, hit their estimate, hit. This was a miss, this was a miss. Now, yes, Q4, sooner or later it's gonna report. And as you can see, this was just a slight decrease. It wasn't something as low as they had in Q1. You see, Q1 they wanted it to go up, and now it's starting to trend down. We'll see on the next year for 2023 Q1. We'll see if they actually lowered estimates for Q1 in 2023. Now we have here, I want to see some yearly. So return on assets, about the same. Return on equity, slightly better. Earnings per share, actually better. I'm guessing their margins have done much better as well. Debt is at 90%. Still high, but pretty average amongst their peers. Typical number. Now, all we have to see is pretty much the cash flow. Now, net income, just want to see that. It has been going up slightly. See here, it's gone up. And then pretty much stayed flat. And now it went slightly up again. So, it's a nice little move. You know, going up then staying flat a little, going up. So, not losing any momentum. It's just slow and steady, which is pretty good. Again, this is what I was talking about earlier in the video. It might not show me every single piece of information that I need, but most of it. So again, I do apologize. I don't have proper information, but I do have enough information. So for the balance sheet, as you can see here, a 90% debt. What kind of numbers are we looking at? So we're looking at 5.5 billion in assets and then close to 5 billion in debt. So sucks to say, but we just have to look at the cash flows, and it looks like they might be breaking even. So this is the most important step when it comes to the bank, is the cash flow. So we want to see what they're doing for operations, investing, and financing. So for operations, 142. Then we have for investing 649 million. So the difference between that, and I know it's 2021, but we can get a more or less accurate number just to forecast for 2022. And then once 2022 shows up, we can see how well they did going, and then we can use that also to go into 2023 as a best case scenario and worst case scenario. So we have basically 500 million, which is negative in cash flow. So the financing will have to be above 500 million. So it's at 581. So they're left with pretty much about 80 million in cash flow. So for 80 million in cash flow, now we want to see how many shares they have. So about 80 million in cash flow. So it's actually not bad. So now for the dividends, they've hiked their dividends in 2021 going to 2022. So that was 4 cents. And that was actually the best raise that they had. Not too bad in 2017 going to 2018, which was from 23 cents to 25, then 25 cents to 30 cents. So that was like a 5-cent difference, which ain't bad. And again, that's per quarter, so really 20 cents. It's actually not bad. That's pretty standard. So they do have a history of paying consistent dividends. I don't see any cuts. Splits 3 for 2 in 2016. They don't do this often, so that's good. And now for this stock, it's telling me it's located where? It's located New Hampshire. So that'll be the Northeast Bank. So again, this company is, again, they tell me in the quants that it has pretty decent quality, above average quality, and the numbers seem okay. So for this stock, again, it's hard to say if these earning estimates here. I don't know for Q1 2023. I want to see if they lowered estimates, kept them the same, or if they're raising them. So it's just all a matter of time to see what happens. So for this stock, overall, I don't really like it. For income, not really. For growth, not really. For stability, maybe. Would it belong in an ETF or a portfolio consisting of many stocks? I wouldn't think so. So again, for this stock, I'm gonna say no. I'm sure there's better stocks than this. So that's my answer for you guys. I'm sure there are better ones out there. So thank you guys for watching. Did better on time. So please be sure to watch my other videos. It's only going to be shorter and better. So thank you guys for watching, and I'll see you guys in the next one.